appreciate you guys coming out tonight. And actually the name of the event is Financial Strength and Intelligence. So we know who's strong and we know who's intelligent because you guys showed up and we appreciate that. Phillip Krause and he's CEO and founder of Krause Capital. We actually met through a colleague here at NSU, which we still don't know how, right? Okay.
Probably my wife.
Yeah. So when I first met with Phillip, I just want you guys to know, I was thinking like many students, because I was one of you guys, and the fact is I was thinking boring, right? I was thinking financials. I was like, oh God, we're going to hear about all kinds of, very technical terms and so forth. But Phillip actually made me feel like I got out of an episode of Ballers. So that was great. I heard the Lil Wayne in the background and definitely felt great. So Phillip, thank you so much for being here today. Again, I really do appreciate you. So today we are going to speak a little bit about credit, loans, how to be, again, strong and intelligent. So Phillip, why don't you take it away?
Sure. Well, I appreciate being here today. One of the things that we talked about initially are some of the questions and concerns that you have, now that you're entering into the workforce or trying to make, we'll say, broader financial decisions and set yourself up for success. And some of the key themes we're going to talk about today are essentially the themes of flexibility, lifestyle, and then ultimately setting up a foundation for yourself. And I think that in many ways, when we were talking initially, I know student loans are a very big concern for many of you. And I think that that's a concern because it's probably your only concern right now for many of you. And it's potentially a large number. So it's something that you're focusing on. I can tell you, I'm in my mid-30s, married, have a kid, just bought a sizable house. And there are many other concerns that you will have further down the road that will probably become more important to you than the primary concern that you have in student loans. And so looking at student loans as a part of how they're, again, a bigger picture is really what we want to go over today so that you can think about how those loans will be impacted by some of the other major decisions that you're going to make down the road, and then ultimately how you can plan for those decisions and utilize whichever loans you choose, federal or private, again, to encompass them into a holistic plan moving forward.
Well, and your wife, tell us a little bit about it. Your wife graduated Harvard Medical School and now is an anesthesiologist, so she doesn't know anything about loans, right?
She, fortunately, she went to school in Colombia. So she's, I'll say costeña, branquilleña. And she basically was fortunate where she came out of undergrad, in Colombia without loans. But she did actually have to take out a loan. She went to Harvard for her fellowship in anesthesia and pain management. And because it was in Boston, she didn't have the money to actually live in what we'll call a safe area in Boston. So she did take out a private loan in order to afford to live in a better neighborhood. And that's something that we thought was a very smart decision because we knew that ultimately she'd be able to repay it within a short period of time. It was about $40,000, and within the first 2 years she was able to pay it off. So those are decisions that we'll talk about today. Why do we take out loans? What are the reasons why we use them? Are we using them for lifestyle? Are we using them for safety, for education? And then ultimately moving forward, we're going to talk more about, again, how those loans fit into the bigger decisions that we'll make.
And I think one of the biggest things that we talk about, we hear about loans, we hear about these repayment programs, and it sounds very confusing. But I think the first thing we should definitely get into is the credit.
Yep.
And to start, if you can talk a little bit about the difference between a credit that is associated with loan, with a loan, versus, and a school loan particularly, versus the credit card or your Macy's card. Tell us a little bit about that and how it works and how it reflects upon you when you're going to buy.
One of the things that we initially discussed is that many of you are maybe looking at operating or owning a business at some point in time. When you go to apply for any type of loan, whether it be a private loan for a bank, there is an underwriting process, and many of you are probably familiar with applications like Credit Karma, understanding your credit scores through Experian and essentially FICO. Those are things that unfortunately we don't learn at home, and many of us make a mistake or have a misunderstanding of how credit works. With your student loans, you weren't necessarily put through that underwriting process. As long as you met a minimum standard, you were essentially given the money without having to go through an underwriting process. That is very different than any other loan you will potentially apply for moving forward for the rest of your life. So I'll say that student loans are different because, again, you didn't have to go through the same type of underwriting process that you will now have to go through if you apply for a mortgage or any type of business line of credit.
Now, I know that, and we'll get into loans in a second, but I know many students, I was one of them that just figured I got to live the lifestyle while I'm in school, and school is very expensive, not here, but other places. And you figure it's already so much, you're going to be paying, what's an extra $5,000 or $10,000? Let's be comfortable, let's focus on studies, let's get the extra tutoring or whatever it is, or extra organic food in the refrigerator. I mean, we all need that, right? So, I mean, there are a lot of differences. And so one of the things I want to start talking about with you is actually, how can some of these students prepare now? The credit is a very important aspect. So what are some of the things that they could start preparing now to make them strong when they do get out of here and make their interest rates, for instance, lower and less risk?
So one of the first things that we talked about was establishing a foundation. You're looking at student loans, again, because it's a sizable number. But my biggest concern for anybody who is putting themselves into the workforce or essentially starting their first career is building up some sort of foundation when it comes to cash management. And there are a lot of things we're going to talk about later on about asset protection and ultimately how a lot of these things go hand in hand. So when you do seek your first career, your first job, I'm more concerned about you building up a couple of months of a savings account. Ultimately having enough savings so that if you lose your job or something unforeseen occurs, that you have the ability to fall back on those monies for a short period of time. Now, credit comes into play with that as well, because many people have maybe 3 to 6 months of savings. So if your overhead's $5,000 a month, maybe $15,000 in the bank. We're going to talk about asset protection a little bit later, because where you keep that money in the bank, whether you're married or single, has a lot to do with the type of account you're going to establish, whether it be a wage account or maybe a tenancy by entirety account. So going back into establishing that core foundation, cash, there's a reason why they're saying cash is king. Cash is very important, and it's important to have most likely ahead of you paying down your student loans, because cash is what you're going to fall back on initially. You also, most of you will have a grace period, maybe 6 months, and then some of you, if you took time off or half time and then went back on, you might owe your loans immediately. So you've got to think about your personal situation when you're going to have to repay your loans. One of the things we're going to talk a little bit about as well is buying your first home and when you plan on doing that. I was speaking to an underwriter at a bank recently, one of the larger banks, an underwriter who looks at, and I know we have a variety of students in here, pharmacy, DO, law, they all look at you differently. DO can apply for specialty loans where you may only have to pay 5% down to get $750,000 in a mortgage. But the other part of it that's important in the eyes of the bank is what income you have coming in on a monthly basis and what expenses you owe. So one of the expenses that you'll owe at some point in time past that grace period is going to be your student loan payment. Banks actually see it as almost like a loophole where that grace period, they do not count that payment against you because you do not have to pay it during that period of time. So the first 6 months when you actually leave school is actually one of the best times for you to purchase a home because the bank is looking at you at a more favorable basis. Now I know that's difficult because many of you don't have the money to put on a down payment at that point in time, but unfortunately that is one of the best times for you to potentially make that decision.
Now, I know you said home, and I know we're going to get into this. I'm trying to jump ahead a little bit, but is that the same when they're trying to buy a business?
So it's another interesting point. Many of you, as we talked before, are looking at starting a business. Now, there are things that you could do that could really hurt yourself in terms of applying for a loan. If you start a business or you incorporate and you do that, then the bank will look at your business as essentially your primary source of income. And if your business has not been around for more than 2 years, it will actually be a detriment to you in the underwriting process. They will look at that as your primary source of revenue. And if your revenue is 0, then it will show that you have no income. You'll probably be denied for that loan.
Fine. So getting into student loans, you said that there's about, I know we were talking about earlier, there's about 43 million people with an average loan of $30,000, and everybody's going to look at me really bad right now. Here we're looking at when you get out close to 160 to 200. And so it's not what our parents had, when we're talking about it. I just spoke to the dental students last week, and, most of their parents had a $20,000 loan, and it was easy to buy a dental practice. And especially with a lot of the recessions we saw, or a lot of what we saw in the recession, it put a detriment on us. And, especially you're talking about individuals that actually want to help people out, go out there, get a business, go out there and live a normal lifestyle like we see, kind of like the American dream that we all watch our own since we've been young. So, with that being said, first of all, when they take the student loan out, should they be, I know you said about your wife, but when should they or should they not be paying, or excuse me, taking out the full amount?
Sure.
So like the max.
Yep. We talked about the need for those monies. You know, you mentioned it's a difference in my eyes between security or a need and lifestyle. If you really are just trying to take out enough for security, then you take out whatever you need, obviously, to pay for your expenses, just to make sure that you can afford school so that you can be safe, you know, or live in an environment that you feel safe while you're studying. If you take out the maximum, just understand that you may have the ability, or you should have the ability, to repay those amounts. So I'm not saying that you can't take out the maximum. Just understand that you're going to put an additional burden on yourself that may be unnecessary over time. But again, federal loans versus private loans. If it is a federal loan and it is the maximum, most people that are guiding you, whether it be a counselor or the school itself, will probably tell you that taking the maximum on a federal loan is acceptable, whereas taking the maximum on a federal loan and then also taking additional private loan is really where people get into trouble, because private loans have origination fees. They might have prepayment penalty issues. They're typically more expensive for you over time. They have very limited, well, they're not always variable, and I'll talk about consolidation as well. I like to talk about myself just because it's easy. But when I graduated school, I had about $40,000 in loans from undergrad. And during that period of time, there was a company, it was called Nelnet. Nelnet was a consolidation firm, like I think there's SoFi. And ultimately, I was able to consolidate my loans where it was a fixed payment. So it's like your standard payment when it comes to federal loans, that's your default payment. Where as long as you pay it, and you pay it over a period of time, I was giving them the right to access my bank account, to essentially to take automatic ACH or withdrawals from my bank account. If I did that and did an automatic withdrawal, then they would reduce the interest rate on my loan by 1/4 of a point every 6 months, with a maximum reduction of about 1% over a period of time. So private loans, if you can afford to consolidate and it's not going to impact your lifestyle, then it's a great way to reduce the interest rate. But I truly feel like flexibility is more important in many ways, because if you need to modify your loan, if you need to go from the standard to some sort of income-based payment, then you can only do that essentially through the federal loan. You would have to refinance again through a private loan and essentially pay potentially more money in origination costs and fees. And we are also going into a, I assume, rising interest rate environment, meaning that the consolidation of future loans is probably going to be more expensive because of the interest rates going up. So the chances of you being able to move from a private loan to a better private loan somewhere down the line is unlikely.
So going back to the maximum aspect, you know, it's very easy to want to live like everybody else, you know, and the fact is, when we see our friends that maybe not in the same field are having the nice cars, the nice clothes, and so forth like that, it's very easy to get caught up in that. I did it as a student, so again, I know, and I learned very quickly that that's not the way to go. When you start to see that your debt is increased, and it really doesn't do anything, because those clothes are going to wear out by the time you graduate and so forth like that. So I know it's like another life lesson and so forth, but it really is an investment into yourself. You know, we were talking the other day, and every time he was like, well, that's actually an investment, and I was like, I'm saving, and I said, I'm not paying into anything. He's like, that's right, you're saving. So that is an investment. So some of these little small decisions are very important. The varieties of loans, you know, we talked about the private earlier. We talked about the private versus federal. So if you go into that a little bit, just so, how many people have private loans in here? Don't be ashamed. Many of you do, I know. All right, we got a few waivers. So private versus federal, and talk about the interest rates as well.
Yep. So one of the things that I gave you as a handout is basically a federal loan repayment, and it gives you an idea of all the different options that you would have available to you. One of the interesting things, and I don't know that any of you have looked into it, but there's obviously programs that are program forgiveness. So essentially, you know, working for essentially a school in maybe a lower income area, or going in the AmeriCorps or Peace Corps. To your point, for many people, you know, I know that there's the concept of keeping up with the Joneses, and my family's the same way in many cases. My wife's friends, all anesthesiologists, you know, all making probably $300,000 to $500,000 a year, significant incomes, and they're all kind of keep up with one another. And that's not me, and it's essentially me bringing my wife back down to reality in many cases and helping her realize that a lot of the decisions that you make when you leave, you know, as you were talking about, if you go out and you buy that big house and you buy that big car, you'll be working to pay those things off for the rest of your life. And so ultimately, I could afford a $2 million or $3 million home, but I wanted one that was within reason. In the event that something happened to me, that I knew my wife could pay for it without me there, and ultimately have no issue. And so it's nice to have the things that you want and to achieve them, and you deserve it. You've worked very hard to get it, but try to go out and get it within reason. And if you have trouble coping with what reason is, you may want to enter into one of these programs and see how other people live in other areas to kind of bring you back down to the reality that not everybody's going to be as fortunate as you are, moving forward in your lives. So.
I was telling Phillip earlier today when we were speaking about this, I said, if any other thing in the world caused the amount of stress and anxiety that financials do, it would be a state of emergency or health crisis. Mm-hmm. But somebody's making money, so, somewhere out there, everybody's okay, and he's still driving the nice car.
But
so.
I joked before when I said, and I won't mention which companies I've worked for, but a lot of what we're taught in financial services in many ways is behavioral psychology. What drives you as a consumer, and how can we help you make the most, a beneficial decision that maybe benefits the two of us? And the industry is changing as a whole, where now they're putting the consumer first, they're changing the standards. But 10 years ago, I was ultimately taught to understand how to manipulate you. How to get you to make a decision based upon fear or greed and direct you down a specific path. And I think that now there's a lot more transparency and there are a lot more resources out there for you to learn about how to handle a lot of those decisions. But it's very important that you take time, and before you make any big decision, like I said, buying a house, buying into a business. We talked about buying into a business, and I'll go into that right now. You mentioned that maybe some of you want to buy into somebody's practice. And you asked me, how do you make that decision? Well, I don't make that decision. I hire a forensic accountant or somebody who understands how to do valuations, who's potentially an accountant or CPA, and I have that person look at the books and records of the business I'm going to buy, and that person makes the decision and tells me whether or not I'm going to buy the business. I can't tell you how many physicians I've worked with as individual clients. You're extremely intelligent, but your intelligence is very narrow in many ways. And I don't mean that to be crass in any way. You're extremely intelligent people, and to do what you do and to essentially go through schooling is very hard and it's very strenuous. But you've had horse blinders on most of your career, and I can't imagine you've had as much time to study finances and estate planning and insurance and business and taxes. There are people that do that for a living, just like you do medicine for a living. And so you've got to find people that you trust and people that are willing to guide you and help you. It doesn't mean that you have to take all of their recommendations, but they will teach you if they're good at what they do, and they will help you make better decisions that are more informed decisions.
Now, we were talking about paying back the full amount of the loan, mm-hmm. and I know that one thing you had mentioned to me was that, a lot of people want to do that right away. Yep. I know some people that have done it in 2 years, 3 years, mm-hmm. and I'm thinking, where are you living?
I actually have clients that culturally, they hate debt.
Yes.
They hate debt, and they don't want to be associated with it. Just again, talking about myself personally, my wife is an anesthesiologist, and she can apply for what's called a specialty loan. And so when we bought our house, we could afford to pay a considerable amount of money down on our home. But a specialty loan for like a DO or a physician, you can put down 5% and get $1 million mortgage. You can put down 10% and get up to $1.5 million. Interest rates are historically, or they at least were in the past couple of years, at historical lows. Why would I take my cash that I can invest in other places, like my business where I make a higher margin of profit, than putting it into my house and ultimately not getting the benefit of a 3.25% mortgage, where on specialty loans you pay no points, you pay no origination fees, it's just straight interest and principal at a fixed rate, 30-year fixed rate. So it's really a good time for you to borrow money if you can get it, especially on a mortgage or a property. The other point of that is we bought the property a year ago, and Fort Lauderdale, for single-family homes, since we're in Fort Lauderdale, it's one of the best communities. I think it's one of the best in the state of Florida. Our property values went up almost 8 to 9% in our neighborhood last year, so I've already made money far beyond the interest rate that I'm paying to borrow that money. We also itemize our taxes, so I'm able to itemize and deduct some of the mortgage interest that I am paying on an annual basis. With all those things combined, it is a no-brainer to borrow money in some cases, not in every case, but those are the things that you need to evaluate when you're making those decisions. Not just looking at, I'm going to borrow $1 million, what does that mean for me? How is it actually impacting your bottom line? and how are you benefiting from it over time?
Well, we also, I mean, that sparked some of the conversation that we had. We spoke about the fact of having multiple credit cards to build your credit, and I always thought, one or two is fine, and then we all get the credit cards in the mail, and the first thing we do is like, cut them up, and we're like, nah, don't play with me on that one. So, the thing about that is, he told me, no, you should have 8 in your pocket, and he actually paid for lunch. He's like, pick a color, and I was like, what's going on here? So, tell us a little bit about the risk association.
Yep, and I'll go into, again, personal decisions that I've made. So when I got engaged to my wife, she's a doctor.
He loves his wife, by the way.
Yeah, I was not able to buy a small ring, let's put it that way. But I did not want to use or deplete.
You wanted to wake up, right?
Yeah.
Anesthesiologist.
Yeah, exactly. Yep. That too. So I wanted to make sure that, I got something that I thought that she would like. And ultimately, I didn't want to deplete my cash, to do so. So there are certain banks like Wells Fargo, they have specialty jewelry loans, and you're able to get those loans at no interest for 24 months, up to a pretty substantial number. So ultimately, I borrowed most of the money to pay for her ring because it cost me nothing. I was able to essentially borrow a significant amount of money and just pay it off like I would a car payment over time, and it didn't cost me anything in terms of interest. Those are great loans. Those are great decisions, because what I could do with that money, instead of using it to essentially put down on the ring, I was able to defer it into my 401k and save for retirement. And again, those are the types of decisions that you can make that in the long run will have a big impact on what you do.
Now, the tax deduction aspect of loan repayment,
it's actually pretty simple. There's a maximum up to $2,500, and it's dependent upon your modified adjusted gross income. And so ultimately, I don't believe you have to itemize to take that deduction. It's just on your 1040. At some point in time, if you make too much, you'll have to look at the phase out. And again, this is a question really for your CPA or accountant that you hire. Once you reach a certain amount of income, then it is phased out. You'll no longer be able to take that deduction. But ultimately, if you buy a house and you have a business and you have ways to itemize, we'll go into that a little bit later. Those will become more important to you than even itemizing your student loan debt. How you incorporate, how you operate your business or practice, and then ultimately how you pay yourself from that business.
And I want to be clear here. I know that we're talking about business, and many of you are like, I'm not going to have a pharmacy maybe. But the idea is that many of us have businesses outside of pharmacy because, again, we're smart and not narrowed. But the idea is like some of you might be a real estate agent. Some of you might be a consultant, and have your own practice. And we'll get into protection a little bit in a second here about how to actually double down on that.
And I'll talk about that too. And again, just going to go into what my wife does. So she is a doctor, but she also can act as...
She's watching live, right?
I hope not. But she can also act as a rep for a pharmaceutical company or for some sort of a medical device. And that's separate income that she makes. And she makes that income if she wanted to receive it in the form of a 1099. They'll also pay her if she wants to have it paid to an S corporation or a corporation of some sort. So at the end of the day, as we've talked before, I've negotiated medical contracts for her. I've negotiated her reimbursements with insurance companies. There's a lot of different moving parts in businesses, and how you incorporate and how you receive those payments also has a lot to do with how you protect yourself in terms of future liability. So we're going to go into asset protection at some point in time, but personal and professional liability is very important for me. As you heard in my bio, I do a lot of litigation type planning, and I work with clients in medical malpractice. I work with clients, that ultimately are either the defendant or the plaintiff. They're either being sued or they're suing somebody. And it's very important that you understand that there are a lot of things that you can do, like setting up a wage account. And I actually included another handout. Setting up a wage account might be one of the primary things that you do. If you're married, looking at potentially a tenancy by entirety account with your spouse. And then again, one of the other things that we talk about in here is just simply looking at who your auto carrier or homeowner's insurance is. So if you have auto insurance through a Geico or a State Farm, looking at an umbrella or liability policy to protect you in the event that you do get sued above and beyond what the coverage limits are of those policies. It is something you don't normally think about, and it doesn't cost you a lot of money to get that extra coverage. But when you go into a professional career, you now open yourself up to further liability, especially in medicine, then you've got to be aware and cognizant of the fact that you live in Florida. Some of you might move to other states, but Florida is one of the most litigious states in the United States, and there are a significant amount of lawsuits that occur here for no reason, especially because you're going to carry a card that says that you are pharmacy, DO, law student. You're a target, because of the professional career that you've chosen.
Well, and the thing about it is too, is I think for our medical malpractice, for us, is about $140 a year, and I still find pharmacists without it. And the fact of the matter is, I worked on expert witness cases with some pharmacists, and I've seen where pharmacists were sued directly from either a hospital or a corporation because that hospital or corporation was able to transfer the charges onto the individual. And so that's a huge issue. And the fact is we're not protecting ourselves. Everybody always tells you to protect your and so the idea is you need to protect yourself. At the end of the day, we're going out there, putting ourselves online. We are in the business of helping people out, right? Whether it be law, whether it be business, whether it be finance, the idea is that we're guiding people. Our sales or our marketing is about how you, the person, the customer, the client, can live a healthier lifestyle. But sometimes we may overstep our boundaries and say the wrong thing. Or we might not be living up to the standard of care, whether it be a bad day or a tired day, long hours, whatever the case may be. You can't predict those things to happen. So ideally, personal and professional branding are protection. But you also spoke about earlier. You said that if they open a business, mm-hmm. and I know we're about to jump right into that, but if they open a business and they use a personal card, like you said, a credit card, mm-hmm. they actually take all liability.
It's if they personally guarantee. So if you set up a corporation, let's say, and you joked about me having 8 credit cards in my pocket. Those credit cards are associated with different companies. So each card is associated to a different corporation, and I make sure that my finances are separate and essentially consolidated within a box with each company, because I want to essentially consolidate the liability. I want to have some form of an arm's length liability so that I'm not what's called commingling assets, are essentially separate from you personally, and making sure that if you had to, and actually goes into a lot of physicians in Florida, unfortunately, that practice without medical malpractice. Many of them, if something happens, they literally walk away from the company they've established and set up another one. And that's the unfortunate part of it. But we can go into asset protection as well and talk about why that happens and ultimately how you can protect your assets in the event that you weren't successful in business. And that's a reality in many cases.
And I know that some people, when they start their businesses, they open up with a private LLC, and they then have that LLC own the percentage, mm-hmm. whether it be 100% or a piece of it, of the corporation. So that kind of puts a double standard or double measure, double protection on their company their personal.
Yeah, we're getting into more of the legal side of things. Neither one of us are attorneys, so don't take that advice from us. But single member LLCs in Florida have been questioned in the past. So at the end of the day, you're better off using more traditional aspects of asset protection like homestead, like life insurance, annuities, wage accounts, tenancy by entirety, things that are available to you, because establishing a company and the way in which you incorporate and how you manage that business, if you are liable, if you did something serious, injured a patient or caused harm to somebody, they're going to hire a bulldog, they're going to hire a shark to go after you. And so chances are, what you've done, if that company isn't run in terms of what's clean hands, like if you've done nothing wrong, you might get away with it. But at the end of the day, looking at more traditional methods, and I don't know if all of you are aware of what was called homestead in Florida. There's a reason why many people that have committed, crimes move to Florida, and it's because you can essentially put an unlimited amount of financial resources within less than half an acre of a property. And so you can buy the most immaculate, ostentatious house that could be worth $10 million. And as long as it's under that half acre, if somebody sues you in Florida, they cannot take that asset from you. So there are a lot of people that come here to Florida and buy homes and put all of their money into their property, so that in the event that they are sued, you can essentially live off the equity in the property without that being taken from you.
Okay. So now getting into starting a business, I know we touched up on a little bit. So talk about the tax benefits from that aspect.
Sure. So, one of the reasons, and it's really different in the field that I'm in and really the field that you're in. You talked about LLCs, corporations. I have an S corporation, and I have an S corporation for a reason, because an S corporation, you can essentially itemize business expenses and take those right off the top. So if I have rent of $1,000 a month, I can deduct $12,000 a year. And if I made $100,000 that year, then ultimately I'm only paying taxes personally, because it's a pass-through. You pay taxes, ordinary income. I'm only paying taxes on the remainder. So whatever business expenses I have, if I made $100,000 and I have $20,000 of business expenses that I've itemized, then I'm only paying income on $80,000. So how you incorporate has a lot to do with how you're going to pay income at the end of the year. And this actually leads into what you can do in terms of creating your own benefits under your business. So establishing your own insurance policies, your own retirement plans. And I'll talk about a little bit about how I started my business. Back in about 2007, 2008, you talked about how many of you are going to go into maybe the private sector first, not necessarily work for yourselves, but work for somebody, maybe have the ability to start saving money. I worked for a period of about 5 years in the private sector where I was an employee of a company. And I was able to defer enough money into my 401k plan every year that when I started my own business, I was able to take a loan. And you can take a loan up to $50,000 or up to 50% of the account balance, whichever is greater. You can take a loan, and the IRS will let you take that loan and use it for whatever purpose you want. The primary time that I took that loan was to start my business. Website, incorporation, business cards, branding. So I used that money from my retirement account to essentially fund my startup. The last time I took that loan was to buy my car, because at the end of the day, if I don't have to go to the bank and borrow money from the bank, if I can do it for myself and do it in a way where I'm paying myself back with interest in a plan that's accruing monies for my retirement, then I'm doing two things. I am continually saving the interest that I would have paid the bank, and I'm paying it to myself. And I'm also not hurting my credit, because I'm not borrowing money from an institution. I'm borrowing it for myself. So ultimately, if you do things and you start early on in your career, and you start, and many of you might laugh when I say start thinking about retirement early on. It's not necessarily about retirement. It goes to the same concept of flexibility. If you start doing things early on, you create flexibility. You give yourself options down the road to do some things that might be more creative than you might have, alternative options.
Well, and it goes back to what we were talking about as well, foundation. Mm-hmm. And you're setting that foundation here, basically, again, protecting yourself, but finding a way to be financially smart. I mean, at the end of the day, you're not
financially independent.
Yeah, and you said this. You said if you had an extra $500, where do you put it? Do you put it into something that's making more interest, like your 401? I don't know if you know, but certain places you put in 4%, and they give you
contribution. Yep.
Some places give you 10.
Yeah, the employers that you work for, corporate employers will probably have some sort of a safe harbor program where it's essentially going to match, let's say, the first 3% or 4% that you put into the plan. The benefit of when you operate your own business, so I have what's called an individual K plan, where I have my own 401k that I establish for myself individually. So I can defer upwards of about $18,000 a year and defer that from my income. But the other benefit is that the company can also make what's called a profit sharing contribution. So not only am I deferring income, if I was going to pay myself $50,000, I would defer $18,000 of that. So I'm saving income tax today on the $18,000. Then on top of that, if my company has excess profits of, let's say, another $50,000, I can defer an additional 20 to 25% of my covered payroll as an employer contribution. So the same concept you're talking about, where if you make a contribution to a 401k at your employer or 403b, the employer might be matching your contribution as well. When you run your own business, you can actually match your contribution, but on a larger scale, what's called a profit sharing contribution. I can then also set up a defined benefit pension plan and defer further monies, so that if I made $150,000 to $200,000, I might be able to defer almost 40% of that in 1 year and save 40% on what I would normally have paid income taxes on those monies. So there's a lot of options that you'll have down the road, but it's slowly and steadily teaching yourself what those options are. And then when you do start your business or you do work for a company, we're going to talk a little bit about employee benefits, knowing what benefits you have, and then if you leave that company, what benefits you can recreate for yourself, and if there might be better options for you to do that as well.
All this deferment, we might need to see this guy's taxes. A little scary over here. So actually, let's get into employee benefits, because that was one thing that really excited me when you were talking about. We had talked about state revenue tax. I know for one thing. But we also talked about what job you're going to pick, or if you do change job, what are you looking for? A lot of times we look at the salary. That's the first thing we look at, and then we say, do they provide insurance? So a little bit deeper into that and how you create investments to that.
But I want to talk about kind of a life story. So when my wife was looking for her first job, there's a very competitive nature that you all have. And like you said, the first thing that many of you look at is how much money am I going to make? You know, what is that ultimate paycheck going to look like? And that should not be the primary factor. My wife is Colombian. She's got a very strong accent. And she chose to take a job over on the west coast of Florida, where ultimately she was working with a pain management group that was probably the best in the West Coast. But her being a Colombiana, strong accent, on the west coast of Florida, I don't know if many of you know, there's not a lot of Latinos and Latinas on the west coast. It's predominantly Midwestern, people from Indiana, Kentucky. And so she would go into her medical practice every day with her very heavy accent, and they would ask to see where the doctor was, you know, essentially assuming she was the nurse. And then she would have issues communicating with the patients because they couldn't understand her. And it became a very frustrating environment. And even though she chose the job where she made the most amount of money, and she made more money than anybody else in her graduating class, she became very discontent and unhappy with the situation she put herself in, where after a year we were out of there. You know, we moved back to the East Coast where she would feel culturally accepted and happy. Now, if you're going to make that decision to essentially work in a place where you're just there for the paycheck, be very careful, you know, because you could be setting yourself up for a very miserable existence. And if it's for a short period of time and you understand that, at least come to the realization that you're doing it maybe to pay off student loans or to build up some assets and put yourself in a better position so that you can relocate to a place where you're going to be happy.
So wait, you're capital guys telling us that money doesn't buy happiness? Okay, I'm just making sure everybody's on the same page.
I guess you have to live through it first to, you know, to experience it. But no, you'll realize money is important for financial independence, but I don't believe that it's the number one way to make decisions. I think you have to look at all the other options. And I think the best way to do it, what I made her do, is just a T-chart, pros and cons, and then assigning essentially points, 1 point, 2 point, 3 point. Do you like where you live? Are you happy? Are there a lot of people here? Just looking at a very simple way to analyze it, and then whatever the points add up to, that's how you can make your decision.
Well, the other thing we talked about was medical benefits. I know that's one thing that's huge, but also the disability benefits. I don't think many people, especially young individuals, don't think that they're going to be disabled. I spoke again to the dental school a week ago, and I realized that 25% of all dentists will see disability before they meet retirement, which is crazy. We're talking about, 65 is not that old. I hope I'm not disabled by the time I'm 65. But who knows? Those things happen. So, I know there's a huge gap in that, and they only pay for a certain amount, up into a certain amount. So, yeah, so when you're looking at benefits you're going to receive from an employer, we obviously talked about medical insurance, and the next one would be disability insurance. Disability insurance comes in two forms, short-term and long-term. The one that you're going to be primarily concerned with is your long-term disability benefit. If the employer is paying those premiums, it's going to be a taxable benefit. So if the benefit stipulates that it's 50% of your salary, then it's 50% of your salary, but it's also a taxable 50% that you're receiving, just like you would your salary. So if your salary is $100,000 and you become disabled through an employer-sponsored plan, you're going to get $50,000 a year of taxable income to cover that gap. That's not going to cover the gap that you need, obviously, to survive at the lifestyle you had before, or to even potentially support yourself if you have some sort of an injury. So the next thing you'd look at is potentially what's called a portable policy or an individual policy. If you pay for your own disability policy, the benefits are actually tax-free to you, and you can typically cover up to 60% to maybe even 70% of your income on a tax-free basis, which is a pretty significant gap that you're covering. And you can cover it up to an age like 65 or 67. Disability insurance should cost you about 1 to 2% a year of your income. So if your income is $100,000, it should cost you about $2,000 a year to cover that income through a private policy. If you apply with somebody who is in your same occupation class, so if 2 pharmacy students or 3 pharmacy students apply together, you will actually get a discount on that policy of about 10 to 15% because you're applying as a group, a multi-group discount. So that's important, again, because like you said, we don't think about disability as occurring in our lifetime. It occurs to, I believe the statistics are about 60% of us, and it usually occurs obviously later on in life. But it is a reality, especially obviously in South Florida, places where you have terrible drivers. But it's a reality in many cases, and buying it now
just like we'll talk about life insurance, buying it now is important because it's cheap, it's affordable. You're young, you're not a high risk for the insurance company, so it is extremely cheap.
Now you could buy this outside of your company, because I think that a lot of people think when they go into a company, it's just whatever you're handed. And so it's very, very good to know that you could be doing these things on your own. And again, it makes an investment within.
Correct. Covering your income is a very big investment, especially if, again, if you're in a specialty career, if you're a physician, or if you're in law and you need to use your brain, your hands for surgery, you've got to insure those things. If J-Lo insured her backside, then you should be insuring your hands if you're a doctor, if you're doing surgery. And it's crazy, but athletes, people that are in different professions, they insure all different parts of themselves because without those parts, they couldn't do their jobs. And if you think about how much money you're going to make over your lifetime, just starting maybe next year, the following year, over the next 30 or 40 years, you're probably insuring about $5 to $10 million worth of income over your lifetime, which is probably one of the most important things aside from insuring your home or any other asset that you have.
So actually, now that you said home, let's get into homes. And I know, again, it comes back to our generation as well. Buying a home is not really a normal thing anymore. We hear about the lifestyle. I live in a condo. I know a lot of friends that live in apartments, condos, and so forth. We rent. I know that there is a development peak that they were talking about today in the Sun Sentinel. How important is buying a home? You said in the first 6 months, I know that was a big thing for you, but talk a little bit about that for everybody, because I think it's something that needs to come back.
It's really a question of what's important to you. Buying a home is a big decision because you're essentially rooting yourself someplace. And once you buy a home, it's not that easy to get out of that obligation. Renting it, selling it takes time. It's also costly. There's transaction costs in buying and selling a home as well. So buying a home is really important, as you mentioned, because it's an asset that you can accumulate wealth within. And when you talk about being at the height of development, I don't care. I bought my house a year ago. I'm going to be in my house for hopefully the next 10 to 15 years. I'm not worried about a housing market, correction or crash, because most of those market cycles don't last 10 years or 15 years. Even look at the last one. It lasted maybe a period of 2 or 3 years, and then we came right back up within about a 5 to 6 year period. So if I'm investing in a property or a primary residence, as long as I'm going to be there for a significant period of time, the price or the date in which I purchase it is not as important to me as making sure that I'm accumulating wealth within that asset, that I'm essentially starting to accumulate what it is that I feel is becoming wealthy, or at least becoming financially independent. The other benefit, as I mentioned before, is ultimately looking at the specialty loans that you may be able to apply for. So in many cases, underwriters of mortgages are going to look at you in the next 6 months, and they'll see you as more favorable because you do not have to pay that student loan on a monthly basis. After that 6-month grace period is up, they will look at you less favorably because you'll have an additional payment that you'll have to make monthly, and they will count that against you as your ability to obviously make whatever payments you have to on a monthly basis.
It's crazy because we were talking about this as well, that when we get loans, especially school loans, they're very easy to get, and we don't have to pay them, so what's not in sight, it's not in mind, right? And credit cards are easy to get. Like I said, they come in the mail like every other day. I think it's a waste of paper, but when it comes to buying a business or loans, that can make or break you, and that's why we were talking a little bit about the credit aspect, because, for instance, when I opened my own business up, I thought, okay, I'll just go get a business loan. And then you come and realize that nobody's going to give you more than $3,000 to $5,000 if you don't have stability behind you. And they start, oh, well, maybe I'll get a partner, and we could share the credit, and same situation. You start to realize that everybody around you is thinking the same. Some people will give it to you with a 20% interest rate on it. Yep. Everybody's willing to give money away, but the interest is what it comes down to. So that interest rate can break you. I know guys that make so much money by just loaning money out to people that are in desperate need because they want to start their aspirational. I want to start this business. I want to, buy my own things and say I'm my own boss. And what happens is they can't pay their employees. They can't pay for the small, they're not even looking at some of the merchant accounts, it's $75 to $100 a month. These are little things that add up. And you want to talk about marketing in today's world with digital marketing? Please be my guest. You're talking about a good digital marketing with management about $20,000 to $25,000 a month. to reach the right clientele and focus group, because we're in the world full of digital now, right? So having good credit is probably the most important thing. You know, being able to start early, I think, is the most impactful thing. You know, it's never too late to build your credit. I mean, I know that some people may have said screw credit and just went away with it, but it's never too late to build your credit, and you know, I think you need to start as soon as possible.
Yeah, well, to your point, starting as soon as possible is important in the eyes of the credit rating agencies and how they view you, because credit history, how long you've actually had credit, and your consistency to make payments on time is one of the most important factors. You know, also looking at, you mentioned starting a business. I can't operate my business without credit in many cases. You know, if you're working in a pharmacy, or you have your own pharmacy, or you have a medical practice, or even a law firm, you need credit because you have expenses you have to pay on a monthly basis. And as you become more successful, as your overhead grows, credit becomes very important because you cannot rely upon people to pay you on time. And if you're a physician in a private practice, as you start taking, you know, if you're a dentist or, you know, DO and you have a private practice,
How about a pharmacist?
Or pharmacist, you ultimately have to rely upon the reimbursements of the insurance companies or receivables coming in. And how are you going to pay your bill when those receivables don't come in for 60 days? You know, so you need to have the ability to have sizable credit, but you can get credit if you can show that you have consistency of income and revenue coming in the form of receivables. That is ultimately how you borrow money, is you go to the bank and you say, these are all of our receivables. This is all the money that's owed to me. These are the companies that owe me money. They are solid creditors, or ultimately they're going to pay me, but I need to have the money to essentially float my business, to pay for my expenses in the meantime. Almost every small business that I'm aware of operates in a similar fashion in that respect. So you've got to be able to, like you said, start early and show to the credit card companies or to lenders ultimately that are going to give you those loans that you are responsible, that you are consistent, and then ultimately you have to have a business that shows that you have consistency of income and revenue coming in before they'll give you the type of loan that you need to operate that company.
Well, coming from your business, you know, we do see a lot of financial managers coming out. You see the Northwesterns, the Mass Mutuals, all these different companies, right, on LinkedIn. And there's always that one person on LinkedIn that's like, hey, how you doing? Just wondering if I could help you in any way. And then you're just like, okay, this is kind of shady. So then they start talking about life insurance. And I know we spoke about life insurance, and then you said there's two ways to look at life insurance. Mm-hmm. There's the life insurance, or the investment insurance.
There's, so again, I'm not going to mention which firms I've worked with, but early on in my career, I was taught, as we mentioned before, that life insurance can be a combination of an investment and essentially covering a need. There's really two types of insurance. There's term insurance, and then there's permanent coverage. And permanent coverage comes in a variety of flavors and colors. Term insurance, I think, is great because ultimately I have a son. He's a year old. My wife's in a very high liability career. So what I've done is I've set up what's called a trust, and the trust owns the insurance policy. And I've done that for a reason, because I know that there's a point in time where if something happens to me, my wife might get remarried. My wife might get sued because of her career. And I want to ensure that the insurance policy that pays out into a separate entity known as a trust that is separate from her individually, but can still benefit her if she needs money or my son needs money. So life insurance is important, but the way in which you structure it is also very important. The policy that I purchased was a term insurance policy. Why? Because I don't necessarily feel like I need to accumulate money in an insurance policy. I don't necessarily see it as an investment. There are financial planners and advisors who would completely disagree with me, and it really depends upon your personal situation. I would rather put money into my 401k or my profit sharing plan or my defined benefit pension plan, plans that I control the investments within, than to put it into an insurance policy where the fees and costs are very high, and ultimately I might have very limited control into the types of investments or fixed accounts that I can choose from. So I made a personal decision to put more money into my retirement accounts than to look at putting money into, let's say, a whole life or a variable universal life insurance policy. You mentioned the companies that I won't mention because I don't want to, again, slander anybody.
They don't sponsor me.
That's okay. Those companies are good companies. They offer great products, but not all those products are good for you at this point in time in your life. Do not be tricked or persuaded that an insurance policy that is an investment is the right thing for you at this point in time in your life. If you do not have a strong foundation, if you do not have the ability to go out and buy the things you need, like a home or something else, you may want to go with a cheaper alternative just to cover your needs. Buying life insurance now is great because it's, again, like disability insurance, it's extremely affordable. For $30 or $40 a month, you've heard the commercials on TV, for $30 or $40 a month, you can get $1 million life insurance policy. You can. At your age, for $30 or $40 a month, you could probably get a $500,000 to $1 million term insurance policy for 20 years. As you've seen or you're going to see with the patients and people you work with, you don't know when some sort of a condition could come up health-wise, and you may not be able to get insurance at some point in time in the future. So being able to apply for it while you're healthy, and you can apply for it and get it approved very quickly is important. Just because, again, 10, 15, 20 years, I'm 34, I can tell you between 24 and 34, a lot of strange things happen with my body. I used to run track, play football, I was working out a lot. Then I started working, and just working in general, and your life changes, and hopefully your lifestyle doesn't change enough. This guy stays in good shape like every day. But hopefully your lifestyle doesn't change enough. Yeah. So while you are capable of getting these things, it's important because it's cheap, and ultimately if you're going to have a family someday, you might as well get it anyway. You know, it's not going to cost you a lot, and it's the same as saving money for yourself as well, which we'll talk about in a second, the concept of investing and how to do that at this stage in your life and how, you know, that's the best way.
Well, so, with the life insurance, really quickly, it is a non-taxed.
If you buy it, if you pay the premiums, and yes, it is the death benefit is tax-free to your beneficiaries. So ultimately, it is one of the best investments, you know, unfortunately, that you can make that you won't enjoy, but it's one of the best investments you can make in terms of the rate of return that you get on the monies that you pay.
But you could take it out early, can't you?
If you have an accelerated death benefit, you know, if you have a serious illness, cancer, or something with it determined that you're only going to live for a 12-month period, then yes, you could potentially tap into the policy and utilize the proceeds. Where in many cases, let's say you don't have the money, excuse me, you don't have the money to get the best treatment. You know, you have cancer and you don't have the money to get the best treatment. The insurance policy you can actually use to potentially pay for that treatment if you have an accelerated death benefit. So there are other benefits that you can potentially enjoy or use while you're living.
So before we go into the questions, let's go over the investment aspect really quickly. Tell us a little bit about the investment planning.
Sure. One of my clients once said to me, keep it simple, stupid. So I think that's a good way to look at investing. Investing has changed so much in the last even 10 years. When I started in investment planning and management, it was heavily pushing mutual funds. Mutual funds essentially pay a commission to the financial advisor or broker, and it's either a commission up front or a commission over time. That model has completely changed, where now it's more of a model of charging a fee or a percentage of assets. So most financial planners that are going to work with you are going to charge either a flat fee or they're going to charge you a fee annually, like 1% to manage your assets. Unless you have a sizable account, you know, unless you have a significant amount of money, and significant is in your eyes, you know, where you feel uncomfortable managing it, I would go with a very simple index fund or ETF portfolio through companies like Vanguard, Fidelity. Set something up that you can manage and control and learn how to understand, and try to avoid fees early on, because fees is what's going to eat away at your rate of return. It's going to hurt you in terms of your long-term growth. There is an investment theory or methodology called dollar cost averaging. It's what we all do when we put money into our 401ks and ultimately any type of retirement plan. It's very simple. If you put $100 a month into your plans and you buy, let's say, a stock like Apple, every time Apple goes up, you're buying less shares because the price has gone up. Every time Apple goes down, you're buying more shares because the price has gone down. Dollar cost averaging is essentially doing the core tenets of investing, which is buy low, sell high, but ultimately you're going to buy more shares when something's low, and then you're going to be in a position to sell those shares as the price per share goes up. Most people fail to follow the basic tenets of investing because they're emotional investors. Investing is about being disciplined. It's about putting yourself first, treating yourself like a bill, and ultimately paying yourself on a monthly basis and doing it in a very simple and cost-effective manner, so that when you look back 20 or 30 years from now, you've done something obviously that was a no-brainer. You know, you've saved for yourself, and it's really not as complex as you think. We talked about the concept of diversification. You can buy an index fund, you can buy a Vanguard S&P 500 fund that's pretty well diversified, or you can go to a lot of these companies and they have managed accounts or managed funds that you can buy from them as well, and they'll manage the monies for you. So those decisions aren't very difficult decisions. It's just understanding how to do it, something disciplined, and then sticking to it, and not getting emotionally caught up in whether or not it's the right time to buy something or sell something. I do believe that it's more of just doing something disciplined over time, and really almost, I don't want to say not looking at it, but I've tended to see that people that don't look at their investments, that ultimately just do something disciplined, end up being better off than the people that are constantly changing and modifying their investments.
Well, we appreciate this, and let's take some questions. Does anybody have any questions in the audience? All right. Let me. Actually, I'm gonna come down to you. I like being personal with you guys. Well, I'm coming to you.
Hi. So you were just talking about Vanguard index fund, right? So it's less management. I've read previously a little about
Passive management versus active management.
It's all very new to me. I didn't even understand what the mutual fund basically. So is it low management? As in, do you have to check what's going on with your investment every month?
So when you talk about
how do you manage it?
Sure. When you talk about passive management versus active management, it's actually an interesting subject, and it's like a philosophical argument within financial services. Some advisors will tell you that active management is better, because without active management, it's hard for them to sell their service, to prove their value, and tell them that it's beneficial for you to pay a higher fee in order for you to use an active manager. There are ways that you can evaluate an active manager and the value that they bring to the portfolio. That's a completely separate subject. What I was talking about is passive management. So passive management is buying like an index fund, like the S&P 500, where you own essentially a broad basket of some of the largest, well-capitalized U.S. companies in different sectors: energy, healthcare, financial services. And when you say do you have to manage it, well, ultimately, you own such a diverse group of companies that you really are diversified enough where ultimately that diversification is the management in itself. Now, that's just U.S. companies. So when you talk about buying other companies to maybe further diversify the portfolio, you can look at investing internationally. You can look at investing in other types of investments like fixed income investments, like bonds, real estate. You can go sector investing. So right now, sector investing might include, and I'm not going to get political, but let's assume that our government increases defense spending, or we modify the Health Care Act where it becomes beneficial for insurance companies. That's sector investing. That's looking at a value and seeing how it changed in maybe our system would be beneficial for you to invest in that sector. So you might want to invest in healthcare, invest in some other area. So you don't have to manage it yourself.
So pretty much it's like paying your bills every month. You just set up an auto payment.
There are investments that you can get the best of both worlds, where they are low cost, but they are actively managed. And companies like Vanguard do offer those types of portfolios. And yes, it's like paying your bills. And it should be that simple, especially at this stage in the game where you're just accumulating assets. I fail to believe that many investment advisors, including myself, have any knowledge or understanding of the market greater than you can find on the internet, or you can understand by maybe paying an extra fee to have analytics or research data that we can get our hands on as well. So. Yep.
Thank you for your time today, actually. I have a quick question about the loans.
Mm-hmm.
I'm really interested in starting my own business, but I'm also concerned about how am I going to get the loans for it and pay everything off. So I was interested when you mentioned the 401k.
Yep.
So can you just go into a little more detail? Like, say I have $200,000 paid off at the end of my 4 years.
Yep.
How can I properly build up my 401k so I can use that money to invest in a business?
So it's gonna depend upon your employer. So if you are going to be employed by a company, then you're going to have the ability to defer money into a 401k plan at that employer and accumulate monies in that retirement plan, which you could ultimately use to borrow money and start your business. And again, philosophical argument, I did it myself because I was young. That's when I feel like I can take risk. I didn't have a wife, I didn't have a kid. So I was willing to risk the monies that I had saved to start my business, knowing that if I failed at that point in time, I'd have the ability to make up some of those monies over time. The repayment period as well is a 5-year period, and you essentially pay yourself back with interest. So if you borrow $50,000, you're going to pay yourself back a little bit over $2,600 to $2,700 every quarter, every 3 months, over a period of 5 years, which is pretty easy to do as long as you can, again, plan for those payments over time. So if you're going into your business right away, it's going to be very difficult for you to get a loan because you have no track record, especially if you're starting a new corporation. You could try to look into some sort of an SBA type loan, Small Business Association, or maybe try to find a grant depending upon the type of work you're going to do. It's going to be very hard for you to get a traditional loan from a bank, and it will take you time to accumulate enough money for it to be significant enough for you to take that 401k loan when you do start the business.
I know you mentioned consolidating your loans, but I know different loans have different interest rates, so how does that work, consolidating all of them?
Well, it's got to be extremely beneficial for you to want to consolidate. Interest rates, I believe, are set by Congress on federal loans. I want to say they're about 8 to 8.5%, somewhere around there. And for me, the private companies that consolidate loans, they're very tricky in the way that they do the consolidation. I might say that there's no interest or that it's a lower interest rate, but then they're also tacking in origination fees or other costs and prepayment penalties. So it's making it more restrictive. And it's also potentially costing you more if they're wrapping those origination fees into the actual loan itself and they're charging interest on top of that. It's an individualized question. You know, it's looking at every loan individually, looking at the interest rates, and then also knowing that when you do that consolidation, you lose flexibility. You know, it's got to be really beneficial for you to do that, and you've got to be very confident that the job that you have or the position that you're in is stable in order for you to want to make that decision moving forward.
Thank you. I have 2 questions for you. The first one is when you talk about putting your investment in the stock market or mutual fund, and I read news and they talk a lot about how ridiculous the stock market is rising.
How the prices are overvalued right now?
Yeah. So do you think that's be the best investment, or if not, what would be the best place to put money?
Yep. I'd say generally speaking, you have to understand your appetite for risk and what's called your time horizon, the amount of time you have to invest. For me, I like taking risk, again, in certain sectors of the market that I think have good potential upside. Good potential upside might be areas of the market like financial services or healthcare or energy because they're undervalued, or I think there's political or socioeconomic or geopolitical changes that are occurring. So when you talk about where to put your money, when I was talking about the S&P 500, that's just a broad basket of investments that's relatively easy to understand. But to your point, some analysts believe that many of those investments or stocks are overvalued at this point in time. So you might want to look at alternative places to invest or maybe sectors to invest in that you think are going to be more stable over the next couple of years, as opposed to buying into, let's say, the S&P 500 when there may be a correction in that market. It's a question of you sitting down one-on-one with somebody and figuring out the type of risk you're willing to take, and then the expectation. I think the hardest thing for people to do, it's like playing poker at the casino. When do you walk away? You know, when do you decide that the money that you've made is enough for you to want to pull it off the table? There is another concept called rebalancing, where ultimately when you make money, you are supposed to take that money off the table and then invest it in an area of the market that's undervalued, essentially making your portfolio back to the original allocation. And what you're doing, the basic tenets of investing, is buy low, sell high. So if something has made money, chances are that it is valued or overvalued, and you want to sell out of that and then buy potentially what didn't perform well. There's a chart in the market that shows the different asset classes, international, fixed, US, small cap, mid cap, all the different classes of the market you can invest in. I believe there's no 2-year period where the same asset class has been on the top and bottom consistently every single year, meaning that these classes, these investments, are constantly fluctuating. So you can't necessarily predict the following year which investment is going to do the best, which is why most advisors will recommend that you spread your risk amongst the different investments within the market. And I like to do that where you have a core portfolio of maybe US investments, US stocks that traditionally tend to be more stable. And then you have a satellite portfolio of maybe some sector investments that you're taking a little bit more risk, but you feel a better potential upside as well.
Yes, in the same questions. I said when you want to open a business, and in this market right now, there's a lot of disruptions. Would you recommend to get a loan or try to from some investor or
That's a good. So that's a good point. It's going to be hard for you to get a traditional loan. I talked about incorporating. When you incorporate, you can actually sell shares of stock in your company to essentially lure investors or try to appeal to investors. So when you incorporate, if you have a solid business plan, you may be able to actually get people to invest in your business if you can prove to them that that business is going to be successful, or if you have a good plan of action moving forward. So don't always think that banks are the best route traditionally. There are other organizations, like angel investors that will invest in your business if you are willing to sell them shares of your business. And just think about, what is it, Shark Tank? That's the same concept.
Remember, though, that people buy into the passion in the person. So that's where it starts. So start bettering yourself, and everybody better yourself. Thank you guys for all coming out. We really do appreciate it. Give it a hand for Phillip Krause. So we at NSU, I know Phil's at the front here, but we at NSU College of Pharmacy and the career space are really trying to do some great things for you guys. I really do appreciate everybody that came out, everybody that's watching live, Facebook as well. The big thing is, look, if you're not prepared, and you already have to face so many barriers that we do have to face, then you're setting yourself up for failure. Phillip, he told me one thing, and this is why I really bought into him, is because he said, I don't care if I get a client out of this. My point is to educate. And I asked him, I said, if I get into politics, Phillip, I said, what is one thing that your friends with all that money will pay for? And he said, I want to fight for education. And to me, that's so impactful, because we live in a society where, again, financial information is not relevant. It's not, it's not something cool or appealing to us. So the fact of the matter is, Phil's giving his time as an expert to come and provide education to you guys. And we're going to have many great speakers like him, but again, I really do appreciate you guys coming. Again, I really do appreciate you coming, so thank you again.
Thank you.
Have a good one, guys.